Most traders believe that winning trades are the most important part of trading. They think success comes from being right more often, from predicting the market correctly, from having a high win rate. And because of this belief, they spend most of their time trying to improve one thing. They try to find better entries. They try to avoid losses completely. They try to increase their accuracy. But after spending enough time in the market, a deeper truth begins to appear. Winning trades are not what make you successful. Risk control is what keeps you in the game, and without it, even a strong strategy will eventually fail. In this video, I want to explain something very important: why risk control matters more than winning trades. Because once you understand this deeply, your entire mindset begins to change. You stop chasing wins, and you start protecting your capital. If you stay with me until the end of this video, you will understand why focusing only on winning trades is dangerous, how professional traders think about risk, and how you can build a mindset that prioritizes survival and long-term consistency. And if you want to continue building a strong trading mindset, consider subscribing to Bull Mindset. This channel is focused on trading psychology, discipline, and consistency. Now let us begin with a simple truth. You can win most of your trades and still lose money. And you can lose many trades and still make money. This sounds confusing at first. But once you understand it, everything becomes clear. Because trading is not about how often you win, it is about how much you lose when you are wrong, and how much you make when you are right. Let us go deeper into this idea. Imagine a trader who wins 8 trades out of 10. That sounds excellent. That sounds like success. But if their losing trades are very large, they can still lose money overall. Now imagine another trader who wins only 4 trades out of 10. That sounds weak. That sounds like failure. But if their winning trades are larger than their losses, they can still be profitable. This is the power of risk control. Now let us talk about why most traders ignore this. The first reason is emotional satisfaction. Winning feels good. It gives you confidence. It makes you feel like you understand the market. Losing feels uncomfortable. It creates doubt. It creates frustration. So naturally, traders try to avoid losses. They focus on winning. But in trying to avoid small losses, they create bigger ones. They hold losing trades too long. They move their stop loss. They refuse to accept when they are wrong. And this behavior creates large damage. The second reason is misunderstanding what success looks like. Many traders believe a successful trader is someone who wins most of the time. But professional traders understand something very different. Success is not about winning often. It is about losing correctly. It is about controlling losses. Now let us talk about how risk control changes your mindset. When you focus on risk, you stop fearing losses. Because losses are planned. They are expected. They are part of the system. This removes emotional pressure. When you focus on risk, you become more patient. You wait for high-quality setups. You do not force trades. When you focus on risk, you think long-term. You understand that one trade does not matter. Now let us go deeper into real trading behavior. Imagine a trader who enters a trade. The setup looks good. Everything feels right. But the trade starts moving against them. Immediately, discomfort appears. They do not want to accept the loss, so they move their stop loss. They give the trade more room. They tell themselves the market will come back. But the market continues moving against them. Now the loss becomes larger. Now the emotional pressure increases. Now they feel stuck. This is what happens when risk is not controlled. Now imagine another trader. They enter the same trade. Before entering, they already defined their risk. They already accepted the possibility of loss. The trade hits their stop loss. They accept it. They move on. The loss is small. Their capital is protected. Their mindset remains stable. This is what controlled risk looks like. Now let us consider another situation. A trader wins a trade. They feel confident. They feel powerful. They feel like they understand the market. So on the next trade, they increase their position size. They take more risk. But the next trade loses. Now the loss is larger. Now the confidence disappears quickly. This is emotional risk management. Now imagine a disciplined trader. They win a trade. They feel good. But they do not change their risk. They keep everything consistent. The next trade loses. But the loss is controlled. Their mindset remains stable. Now let us talk about another important concept. Risk control protects you from yourself. The market is unpredictable. It will always move in unexpected ways. But your behavior does not need to be unpredictable. Risk rules create boundaries, and those boundaries protect your decisions. Without boundaries, emotions take over. Now let us talk about drawdowns. Every trader will experience losing periods. This is normal. But what separates successful traders from struggling traders is how they handle these periods. A trader without risk control experiences large drawdowns. Their account drops quickly. Their confidence drops quickly. They become emotional. They start making impulsive decisions. Now imagine a trader with strong risk control. Their drawdowns are smaller. Their losses are controlled. They stay calm. They continue following their system. Over time, they recover. Now let us talk about another important idea. Small losses are your protection. Most traders fear small losses, but small losses are what protect your account. They prevent large damage. They keep you stable. They allow you to continue trading. Now let us talk about mental frameworks that support risk control. The first framework is survival first. Your goal is not to make money quickly. Your goal is to stay in the game. Because if you lose your capital, you lose your opportunity. The second framework is acceptance of loss. Losses are not mistakes. They are part of trading. Accepting this reduces emotional reactions. The third framework is consistency. Risk should be the same for every trade. This creates stability. The fourth framework is detachment. Do not attach your identity to one trade. It is just one event. Now let us talk about practical exercises. One powerful exercise is fixed risk per trade. Decide your risk percentage and follow it strictly. No changes based on emotions. Another exercise is stop-loss discipline. Set your stop-loss before entering a trade and never move it. This builds trust in your system. Another helpful practice is journaling. After each trade, review your risk decisions. Did you follow your plan? This builds awareness. Another exercise is reviewing your largest losses. Look at your biggest losses. Were they controlled or were they emotional? This helps you improve. Another important exercise is setting a daily loss limit. If you reach it, stop trading. This protects your mindset. If this video is helping you understand the importance of risk control, consider subscribing to Bull Mindset, because protecting your capital is the foundation of trading success. Now let us talk about something deeper. Winning trades can create illusion. They can make you feel confident. They can make you feel skilled. But without risk control, that confidence is fragile. One uncontrolled loss can remove many winning trades. This is why professionals focus on risk first. Profit comes later. Now let us talk about consistency. Consistency is not about winning every day. It is about controlling losses every day. When losses are controlled, growth becomes possible. When losses are uncontrolled, growth becomes impossible. Now let us move toward the final message. You will not win every trade. You will not predict every move. You will not avoid every loss. But you can control your risk. You can control your behavior. You can control your decisions. Let me leave you with one final thought. Winning trades build your account, but risk control protects it. And protection is more important than growth. Because without protection, growth does not last. Focus on controlling your losses. Focus on consistency. Focus on discipline. And over time, your results will follow. And if you want to continue building that mindset, subscribe to Bull Mindset. I will see you in the next video.